I did it again. After the recent price surge, I trimmed 20% of my existing holdings in both DBS and OCBC. Am I cutting my flowers just to water the weeds? Keep watching this Note 2L and breakdown of my latest blog article to see exactly why I made the move.
Welcome to This Explainer. Today, we're going to unpack the really fascinating and honestly kind of counterintuitive strategic mindset behind the portfolio moves of a veteran investor navigating these recent market highs. Because, when your portfolio is absolutely blooming, making the right call can actually be way harder than when things are crashing. We're going to break down a real-world case study from the Fat Investor to see exactly how a seasoned pro manages their biggest winners. Okay, let's just dive right into it. We're looking at a scenario where highly successful, top-performing bank stocks are deliberately being sold off. Now, on the surface, that sounds like a terrible idea, right? I mean, we are always taught to let our winners run. So we really need to uncover the precise strategy and the hardcore mathematical logic behind pulling the trigger on stocks that are doing exceptionally well. To make sense of this, we're going to lean on a pretty brilliant gardening metaphor today to explore what it really means to manage an equities portfolio. You've probably heard legendary investor Peter Lynch's famous advice about not cutting your flowers to water your weeds. Well, today we are focusing on two massive, beautiful flowers in this investor's garden, Singaporean banking giants DBS and OCBC. Now, take a look at these actual sell orders. These aren't just theoretical ideas we're tossing around. These are definitive, real-world actions. The investor literally slashed roughly 20% of their existing holdings in both DBS and OCBC at absolute peak prices. And if we zoom out a bit, this recent move actually brings their total divestment of OCBC to a staggering 60% since last September. That is a massive reduction in a core position. So what exactly caused this veteran to hit the sell button? Because get this, it wasn't fear of a market crash. In fact, this investor happily held these exact same bank stocks through all the intense macro pressures of falling interest rates back in 2024. The trigger for this recent sale was entirely different. It was the sheer gravity-defying velocity of the stock prices. The gains just completely smashed through their wildest expectations. I mean, just look at the runaway momentum in these numbers. We are talking about massive double-digit jumps in literally one single month. Almost a 14% jump for DBS and an over 18% surge for OCBC in just a 30-day window. For mature, large-cap banking institutions, that kind of price movement is incredibly fast and furious, making these banks some of the absolute fastest-moving assets in the entire portfolio. Now, you might be wondering, why is that velocity actually a problem? Well, let's compare these banks to the current semiconductor upcycle. In semiconductors, a cyclical recovery is driving robust sales, which structurally justifies those higher valuations, right? The earnings are naturally rising to meet the price. But with these Singapore banks, while they definitely have resilient wealth management fees, it's so much harder to justify these massive price surges when their actual profit growth is still sitting in the low single digits. There's a glaring disconnect between the price action and the fundamental earnings growth. And that brings us to the absolutely crucial metric right here, 3.6%. This single number becomes the central math problem for any serious dividend-seeking investor, and it is the exact metric that forced our veteran investors' hand. Let's break the math down. When stock prices shoot straight up like a rocket, but the company's dividend payouts kind of just stay steady, your forward dividend yield gets totally squeezed. Looking at the projected FY 2026 numbers, even if management shells out special dividends, the vertical price run leaves OCBC offering a projected yield of just 3.6%. DBS is slightly better at 4.6%, but that historical attractiveness of a 5+% yield, yeah, it's just gone. The math has fundamentally changed. Which brings us right back to Peter Lynch. So where are all these realized profits actually going? Is the investor violating that famous rule and cutting their best flowers just to water the weeds? The short answer is absolutely not. The capital from these sales is not being blindly thrown into underperforming, risky stocks just hoping for a rebound. There's this fantastic quote from the investor that vividly explains the reallocation strategy, and honestly, it's a beautiful way to think about portfolio management. I am merely plucking some overgrown blossoms from my garden at peak bloom and bringing them indoors to decorate my house, turning it into a peaceful sanctuary. So the realized profits are being moved entirely out of the equities garden. They're going indoors into the ultimate safe havens, liquid cash, and Singapore's guaranteed state savings, the CPF ordinary account. Here's the logical anchor for the whole move. Just look at the spread here. You've got a compressed 3.6% dividend yield on OCBC, an asset that, remember, carries actual equity market risk. Compare that to the guaranteed 2.5% interest rate of the CPFOA. When the spread between a risk-on bank yield and a risk-free guaranteed interest rate shrinks this significantly, taking some risk off the table to refill your cash buffer makes absolute sense. You're getting paid almost the exact same amount to take literally zero risk. Now, this is where the psychological mastery of the portfolio moves of a veteran really shines. Despite these heavy trims, DBS and OCBC still account for about 10% of this investor's overall portfolio. They haven't completely abandoned the position. I mean, think about your own top performers. It is tough to let go. But instead of letting emotion rule, they've set up a psychological win-win. The investor genuinely hopes the upcoming first-half financial results are so incredibly good that they actually regret trimming that 20% slice. But, what would it actually take to cause that regret? To fundamentally justify these all-time highs and allow the banks to naturally grow into these elevated valuations, they'd need to report some really exceptional catalysts. We're talking about a spectacular runaway surge in wealth management fees, double-digit year-over-year profit growth, and a noticeably higher return on equity. Proving they're generating way more profit with the money they have structurally pulls down their forward price-to-book ratios. If all that happens, well, that remaining 10% of the portfolio goes straight to the moon. So I'm going to leave you with this final thought to ponder. Is the market brilliantly pricing in this massive future growth? Like, do they know something we don't? Or is this just the FOMO of investors fleeing other global markets and rotating their capital into Singapore, temporarily jacking up the prices? If it's real growth, our veteran investor celebrates big time with their remaining holdings. If it's just FOMO and prices inevitably correct, well, they've got a newly refilled cash bucket ready to buy back those premium bank seeds on the cheap. Either way, by strictly following the math of the yield, the veteran stays entirely in control.